Good morning, dear students. Today we're going to continue discussing chapter 3, adjusting the accounts. Mainly objective number 1. We will continue discussing objective number 1, explain the actual basis of accounting and reasons for adjusting entries. According to this slide, as you see, there are two accounting bases, accrual basis and cash basis. Under the accrual basis, companies should record transactions in the period in which the events occur. For example, if you are using or if the company is preparing its journal entries using accrual basis, company should recognize revenues when they perform the service rather than when they receive cash. So companies should recognize revenues when they perform services rather than when they receive cash. And also, companies should record expenses when incurred rather than when paid. Accrual basis accounting is in accordance with generally accepted accounting principles, and mainly medium and large companies use the accrual basis accounting. On the other hand, we have, as an alternative to the accrual basis, there is cash basis accounting. And under cash basis accounting, companies record revenue when they receive cash. So revenues are recorded or are recognized when cash is received, while expenses is recognized or recorded when cash is paid. And cash basis accounting is not in accordance with generally accepted accounting principles. Individuals and some small companies use cash basis. It can be difficult to determine when to report revenues and expenses. The revenue recognition principle and the expense recognition principle help in this task. So, the revenue recognition principle requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. You should, if you are following accrual basis accounting, we have something called revenue recognition principle, which require all companies to recognize revenue in the accounting period in which the performance obligation is satisfied. A company satisfies its performance obligation by performing a service or by providing a product to the customer. In this period of time, you can record service revenue. You can recognize revenues once you performed the service or you provided the product to the customer, even though you didn't receive cash yet. You should record service revenue in the credit side because you satisfied your performance obligation. And as you see in this illustration, assume that on May, let's assume that this is May, here May. Let's assume that on May, a customer requested from you a service. So a customer on May requested a service. On June, you performed this service. On June, here, you satisfied your obligation. Here is June. You performed this service. In this case, or in this period of time, you are required to record or to recognize revenue. Because you satisfied your obligation, you performed the service. Although you will receive cash as a result of this service on July, you are expected to receive cash on July. So, in this case, a customer requested a service on May, you performed this service or you satisfied the obligation for this service on June, and you will receive cash on July. When you should recognize revenue based on the revenue recognition principle, you should recognize revenue. It indicates that company should recognize revenue in the period in which performance obligation is satisfied. When you perform this service, which is the month of June, here, you should recognize this service. It doesn't matter when you will receive cash. As you see here, cash is received later in July after you performed the service. However, we recorded service revenue, we recognized service revenue on the month of June once we performed our service. What about the expense recognition principle? Accountants follow a simple rule in recognizing expenses. Let expenses follow revenues. So expenses match with revenues in the period when the company make efforts that generate those revenues. So expense recognition is tied to revenue recognition. The critical issue in expense recognition is when the expense makes its contribution to revenue. This may or may not be the same period in which expenses is paid. Thus, expense recognition principle requires that companies should record expenses in the period in which they make effort or they consume assets to generate those revenue. Once you use these expenses, you consumed these assets, you can now recognize this as an expense. Thus, to summarize what we have stated, this illustration summarizes the revenue and expense recognition principles. And if you remember, we have discussed in our prior lecture time period assumption, which indicates that the economic life of a business should be divided into artificial time periods. And these time periods can be usually a month, a quarter, or a year. So the time period assumption indicates that or requires that the companies should divide the economic life of a business into artificial time periods. Then we have stated that based on accrual basis accounting, we have something called revenue recognition principle, and we have something called expense recognition principle. What about revenue recognition principle? Revenue recognition principle require or indicates that revenue should be recognized in the period or in the accounting period in which performance obligation is satisfied. It doesn't matter when you will receive cash. You may receive cash before performing the service, or you may receive cash after performing the service. However, based on revenue recognition principle, you are required to record revenue in the credit side when you perform on the period in which you perform this service. Okay, but what about expense recognition principle? Expense recognition principle indicates that expenses matches with revenue. This means that you should recognize expenses in the period when companies make effort to generate those revenues. In other words, in the period in which these costs and expenses have been used in the operation to generate revenue. So again, expenses match expenses with revenue in the period when the company make efforts to generate those revenues. Then you should know that both revenue and expense recognition principle is in accordance with generally accepted accounting principles. While we have stated before that cash basis accounting do not comply with generally accepted accounting principles. Okay, one of the following statements about the accrual basis of accounting is false. Which of these statements, what do you think? Which of these statements is considered to be false in relation to accrual basis accounting? Letter A, events that change a company's financial statement are recorded in the period in which events occur. This is true in relation to accrual basis. B, revenue is recognized in the period in which the performance obligation is satisfied. We have stated that based on accrual basis, you should record revenue when you perform the service. So this statement is true. The accrual basis accounting is in accordance with generally accepted accounting principles, for sure. D, revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. No, this is false. This statement is false because it complies with cash basis accounting instead of accrual basis accounting. So the true or the correct choice will be letter D. Okay, let's now understand why we need adjusting interest, why we do adjusting interest. For revenues to be recorded in the period in which services are performed and for expenses to be recognized in the period in which they are incurred, companies make adjusting interest, are required to make adjusting interest. Because following the accrual basis creates a timing differences between the time we recognize expense and the time we recognize revenues and the time we receive or pay cash. Thus, adjusting interest ensures that revenue recognition and expense recognition principle are followed. and it is necessary because the trial balance may not contain up-to-date and complete data. So we are required to perform or to do adjusting entries before preparing the financial statements, because in this case, after preparing adjusting entries, our accounts are up to date and we have a complete data. Also, it is required every time a company prepares a financial statement. Once you decided to prepare the financial statement, you are required to prepare adjusting entries before preparing financial statements. Every adjusting entry will include one income statement account and one balance sheet account. It will affect one income statement account and only one balance sheet account. Adjusting entries are made to ensure. Why we make adjusting entries? Letter A, expenses are recognized in the period in which they are incurred. Yes. Revenue are recorded in the period in which services are performed. Adjusting entries are made to ensure that expenses are recognized in the period in which they are incurred, because the purpose mainly of adjusting entry is to make sure that companies are following expense recognition principle. Also, letter Z, adjusting entries are made to ensure that revenues are recorded in the period in which services are performed, in the period when you satisfy your obligation. So, based on the revenue recognition principle, this is true. Letter C, to ensure balance sheet and income statement account have correct balances at the end of the accounting period. This is also one of the main reasons why we perform or why we prepare adjusting entries. So the correct choice is all of the above, letter D. Adjusting entries are classified as either deferrals or accruals. To defer means to postpone or to delay. So deferrals means to postpone or to delay something. Deferrals are expenses or revenues that are recognized at a date later than the point when cash was originally exchanged. The two types of deferrals are prepaid expenses and are unearned revenue. While accruals are divided into two items. One, accrued revenue, and the second type, accrued expenses. So prepaid expenses arise when expenses is paid in cash before these expenses are used or consumed. So prepaid expenses arise when expenses is paid in cash before they are used or consumed. While unearned revenue arise when cash is received before services are performed. You receive cash and you postpone or you delay the performance of this obligation or the performance of this service. The second category of adjusting entries is accruals, which have two subcategories, accrued revenue, and accrued revenue mainly arise when the revenue is recognized for services performed but not yet received in cash or not yet recorded. So cash is not yet received and is not recorded. Accrued expenses, expenses incurred, expenses happens but not yet paid in cash or recorded. A list of concepts is provided in the left column below with a description of the concept in the right column. There are more descriptions provided than concepts. Match the description of the concept to the concept. Okay. Number one, accrual basis accounting. Accrual basis accounting can be matched with letter A, monthly and quarterly time period, of course no. B, efforts or expenses should be matched with revenue, no. Accountants divide the economic life of a business into artificial time period. This is mainly time period assumption or periodicity assumption, letter C. Companies record revenue when they receive cash and record expenses when they pay cash out. Letter E, an accounting time period that starts on January 1st and ends on December 31st. Letter E is matched with the calendar year, because as we have stated before, calendar year start on January 1st and end on December 31st. F. Companies record the transactions in the period in which events occur. What do you think? Companies record the transactions in the period in which the events occur is matched with actual business accounting, or companies record revenue when they receive cash and record expenses when they pay cash out? Of course, letter F is matched with the actual business accounting, because the actual business accounting stated that you should record a transaction in the period in which events occur. What about expense recognition principles? We have stated that expense recognition principle can be matched with letter B. Expense should be matched with revenues. Let's answer some MCQ from your textbook, page 332, which is mainly covering the first objectives that we have discussed. The revenue recognition principle states that letter A, revenue should be recognized in the accounting period in which the performance obligation is satisfied. Yes, it definitely defines the revenue recognition principle. Revenue recognition principle requires that you should record revenue in the accounting period in which you satisfy your obligation, or in the period in which you perform the service. So letter A will be the correct choice. Of course, letter B, expenses should be matched with revenues. There is no relation with, this is mainly covering the expense recognition principle. The economic life of a business is divided into artificial time periods. It's covering, or it's related to periodicity assumption. D, physical year should correspond with calendar year. This is a false statement. So letter E is the correct choice. Time period assumption states that companies must wait until the calendar year is completed to prepare the financial statement. This is incorrect choice. D, companies use the physical year to report financial information. You can use the physical year or the calendar year. The economic life of a business can be divided into artificial time period. Of course, this is the correct choice. Companies record information in the time period in which the events occur. This is related to accrual basis accounting. So letter C is the correct choice. Which of the following statements about accrual basis accounting is false? Letter A, events that change a company's financial statement are recorded in the period in which the events occur. This is true in relation, if we are talking about accrual basis. Yes, this is covering the accrual basis accounting. Events that change company's financial statement should be recorded in the period in which events occur. B, revenue is recognized in the period in which services are performed. Yes. This basis, letter C, this basis is in accordance with GAAP. Of course. Revenue is recorded only when cash is received, and expense is recognized only when cash is paid. This is a false statement, so letter D is the correct choice, because the question here is which of the following statements about accrual basis is false, and this is the only false statement in relation to accrual basis accounting, letter D. Question number 4. The principle or assumption dictating that efforts, expenses, should be recognized in the period in which a company consumes assets or incur liabilities to generate revenue is letter E, the expense recognition principle. B, cost assumption. C, time period assumption. Or letter D, revenue recognition principle. So the principle or the assumption dictating that efforts, expenses should be recognized in the period in which we consume these assets or incur liabilities. Of course, this is matched with revenue, expense, letter E, expense recognition principle. Question number 5. Adjusting entries are made to ensure that expenses are recognized in the period in which they are incurred. Yes. Revenue are recorded in the period in which services are performed. True. Balance sheet and income statement account have correct balances at the end of the accounting period. So letter D is the correct choices because we perform adjusting interest in order to ensure that we are following the expense recognition principle, we are following revenue recognition principle, and also to make sure that our balance sheet and income statement are up to date, all accounts are have a correct balances at the end of the accounting period and are up to date. So letter D is the correct choice. Question number 6. Each of the following is a major type or a major category of adjusting interest except. We have stated before that adjusting interest is divided into two categories, and each category is divided into two subcategories. Prepaid expenses is a type of adjusting entry. Accrued revenue and accrued expenses is mainly a type of adjusting entry. So letter D, recognized revenue, we don't have something called recognized revenue as a major type of adjusting entry. So the letter D is the correct choice. Let's now learn how to prepare adjusting interest for deferrals. Deferrals are expenses or revenues that are recognized at a date later than the point when cash was originally exchanged. And as we have stated before, there are two types of deferrals or two types of prepayments. First type, prepaid expenses, and the second type is unearned revenue. Let's start with the first type of adjusting interest, prepaid expenses. Prepaid expenses, again, arise when cash is paid before expense is recognized, before expenses incurred, before expenses are used. So payment of cash that is recorded as an asset to show that service or a benefit or the benefit of the company will receive in the future. So again, prepaid expenses are recorded as assets, which will provide us with a future benefit. When these assets are used, we now can record this as an expense, can recognize this as an expense. Examples of common prepayments are insurance, supplies, advertising, rent, equipment, buildings. For all adjustments involving prepaid expenses, we should increase for all adjustment involving the prepaid expense, we should increase or we should debit expense account, and at the same time we should decrease or we should credit an asset account. So once we are talking now about a prepayments, which is a type of adjustment, the first type of adjusting interest. If you are required to prepare adjusting entry, you should know that you should increase or you should debit expense account, and at the same time you should decrease an asset account. Once the expenses is recognized, in order to recognize this expense, or once the time passes, so in this case you are required to recognize the expense because we use this expense. In this case we are required to do adjusting entry. And what is adjusting entry for prepaid expenses? Expenses will be in the debit side. You should record expense, increase expense in the debit side. And at the same time, you should decrease asset in the name of prepaid expense or another type of asset. Let's look in more detail at some specific types of prepaid expenses. Beginning with supplies. The purchase of supplies such as paper, envelopes result in an increase of an asset account which we recorded supplies in the debit side. During the accounting period, the company will use these supplies. Rather than recording supplies expense as the supplies are used, the company recognizes supplies expense at the end of the accounting period. So at the end of the accounting period, the company recognizes supplies expense. And this is to save the effort and time. We will not recognize expense each time we use these supplies. No, we will wait until the end of the accounting period and recognize these expenses once we use it. Recall from Chapter 2 that Pioneer Advertising purchased supplies costing $2,500 on October 5. So on October 5, Pioneer Advertising purchased supplies costing $2,500. So if we are required to journalize this entry, you are required to journalize entry on October 5. What do you think? We purchased supplies. In this case, we have supplies in the debit side. If we paid for this in cash, so our cash decreased by the same value, it will be in the credit side. This is the entry or the journal entry for October 5. In October 31st, an inventory count at the close of the business on October 31st reveals that 1,000 of supplies are still on hand. What's meant by when we say that $1,000 is still on hand? This means that we used some of these supplies. Now we are required to do adjusting entry, to make adjusting entry, to recognize expenses, supplies expense which is already used. First, you should determine the value of the supplies used, the amount of supplies used. So supplies used, the equation for calculating supplies. Just a moment. Supplies used equal supplies available during the period, which is $2,500, less supplies on hand. We have supplies on hand, we are given that we have still supplies on hand at the end of the accounting period by $1,000. So the difference between the total supplies available during the period, which is $2,500, less supplies on hand, which is $1,000. So now we mainly used $1,500 of supplies. In this case, you are required to perform adjusting entry on October 31st. And as we have stated before, the adjusting entry for prepayments, you should increase expense and decrease asset. So in this case, you should increase expenses, so supplies expense will be in the debit side. Supplies expense will be in the debit side because we increased expenses by the value of supplies used. And at the same time, you should decrease supplies. Supplies we already have during the period, we have 2,500 supplies, but we used $1,500 of these supplies, so our supplies, our assets decreased by this value, so it will be recorded in the credit side. As you see in the T account for supplies on October 5, we have available 2,500. Then we used 1,500. So the balance on October 31st, you have still on hand $1,000 as a supplies. The second type of prepayments is related to insurance. Companies purchase insurance to protect themselves from losses due to fire, theft, or unforeseen events. Insurance must be paid in advance, often for multiple months. The cost of insurance paid in advance is recorded as increase or as a debit in the asset account, and we call this asset as a prepaid insurance expense. At the financial statement date, at the end of the accounting period, companies are required to do adjusting entry. Companies are required to increase, to debit, to recognize insurance expense, and at the same time are required to decrease credit prepaid insurance for the cost of insurance that has expired during the period. So let's read this example. On October 4, Pioneer Advertising paid $600 for 1 year fire insurance policy. So if you are required to perform or to journalize this entry on October 4, you purchased insurance. This insurance will be used for 1 year, so you paid for something in advance. So in this case, can we recognize insurance expense? No, we cannot recognize insurance expense on October 4 because this insurance is not expired. In this case, it's an asset, which we will benefit from this asset in future. So on the debit side, on October 4, we have something called the prepaid insurance expense. And since you paid for this in cash, so cash will decrease, will be in the credit side. Then, this account show a balance of $600 in October 31st. Insurance of $50 expires each month. So each month you expire, you consume an insurance of $50. In this case, you are required on October 31st, you are required to make adjusting entry because starting from October 4 to October 31st, 1 month of insurance has already expired. So in this case, we can recognize insurance now as an expense. So on October 31st, we should increase debit insurance expense because this insurance for 1 month is already expired, and at the same time we should decrease assets. Prepaid expenses will be reduced or decreased by the same value of $50. Depreciation. Buildings, equipments, and motor vehicles, assets that provide service for many years. Long-term assets are recorded as assets rather than an expense on the date acquired. As you know that any company typically owns a variety of assets that have long life, such as building, equipment, motor vehicles, furniture. The period of service is referred to as the useful life of the asset. And the useful life of a long-term asset is the period of time that an asset is expected to help to produce revenue. So this is the useful life. We are expecting to use this asset, and this asset will help us to produce revenue. Useful life expires because the asset is no longer satisfies the need of the business. On the date we acquire or we purchase the asset, such as equipment or building, it's recorded as an asset rather than an expense because the building is expected to provide a service for many years. As the time passes, companies allocate a portion of this cost as an expense during each period of the asset's useful life. And depreciation is the process of allocating the cost of an asset to expense over its useful life. In this case, an adjusting entry for depreciation is needed to recognize the cost that has been used to recognize the expense during the period. Let's have an example to understand this point. Assume that on October 2nd we purchased an equipment for $4,800, and the useful life of this equipment is estimated to be 10 years. So on October 2nd, we should journalize this entry. We purchased equipment by $4,800. October 2nd, we purchased equipment. So now we have equipment increased in the debit side, and at the same time, if you pay cash, so cash will decrease. This entry for October 2nd. And we have given an information that the useful life for this asset is 10 years. Now, on October 31st, assume that the depreciation on the equipment is $480 per year or $40 per month. So now, once the depreciation we calculated, we have stated before that we have now owned an asset. The cost or the original price of this asset is $4,800, and the useful life of the asset is 10 years. And the depreciation of the equipment is $480 annually or $40 per month. Now we are required to recognize depreciation expense. So on October 31st, you only used this asset, this equipment for only 1 month, from October 2nd till October 31st. So we will recognize expense for 1 month, and the value or the depreciation expense for 1 month is $40 per dollar. So we have something called depreciation expense in the debit side by $40. and the balance in the equipment account will remain unchanged by this adjustment. So rather than decreasing or crediting the asset account directly, Pioneer instead reduces it indirectly. We will reduce equipment but in an indirect way through crediting a new account called accumulated depreciation for equipment. And the accumulated depreciation is a contra asset account. What's meant by contra asset account? It means that it's an opposite of an asset account. So if assets increases in the debit side, accumulated depreciation increases in the credit side. If assets are added in the balance sheet, accumulated depreciation will be deducted in the balance sheet, and so on and so forth. So again, on October 2nd, we purchased equipment, and the estimated useful life of this equipment is 10 years. You are expected to benefit from this equipment for 10 years. On October 2nd, we have an asset called equipment on the debit side, and our cash decreased by the same value on the credit side. Then, the depreciation for this equipment is $480 annually and $40 per month. So on October 31st, starting from October 2nd to October 31st, 1 month, we have used this equipment for 1 month. In this case, you should make adjusting entry. In this case, you should recognize expense. So we will increase expenses in the form of depreciation expense by $40. Can we decrease asset? No, we cannot decrease assets. We should. The original cost of the equipment, we should keep it the same in the balance sheet. However, we can reduce asset by an indirect way through accumulated depreciation. Accumulated depreciation, we can call it a contra asset account. And what do we mean again by contra asset account? It's the opposite of asset account. If you increase assets in the debit, you will increase accumulated depreciation in the credit side. And as we have stated in the prior slide, accounting depreciation appears to be linked to equipment account in the balance sheet, and it is deducted from equipment. This will provide us with something called the book value of the equipment, which is the difference between the original cost of depreciable assets, the original cost here of the equipment, minus or less the accumulated depreciation for this asset. This will provide us with the book value of asset. Okay, the second type of deferrals or prepayments is unearned revenue. Unearned revenue arises when companies receive cash before services are performed. So when you receive cash before you perform the service, before recognizing revenue, we have something called unearned revenue. In this case, company should record a liability by crediting a liability account, because we didn't perform the service yet, and we have an obligation, we have a liability to perform this service in future. We received the cash, but we didn't perform the service. In this case, we should increase liability. Items like rent, magazine subscriptions, airline tickets, and customer deposits for future services may result in unearned service revenue. And an adjusting entry should be made when the company performs a service, and this adjusting entry will result in decreasing or debiting a liability account and increasing or crediting a revenue account. So again, unearned revenue arises when you receive cash before you perform the service. In this case, you should do what? You are not allowed to record or to recognize revenue. Once you perform the service, an adjusting entry is required to record services performed during the period and to show that the liability decreased by this amount. Okay, assume that on October 2nd, Pioneer Advertising received $1,200 from NOx for advertising services which is expected to be completed by December 31st. So we received $1,200 on October 2nd. For advertising services expected to be completed by December 31st. If you are required to journalize the entry on October 2nd, what is the journal entry for October 2nd? Can we recognize service revenue? No, because we didn't perform the service, we received the cash. We received the cash in advance. By how much? $1,200. So our cash increased. Did you perform this service? No, we didn't perform the service. We are expected to complete this service on December 31st. So can we recognize revenue? No, we cannot recognize revenue because we didn't satisfy our obligation. So now we have something, we have a liability, we have an obligation. We call this liability unearned revenue or deferred service revenue. Then in October 31st, analysis reveals that the company performed $400 of services in October. In this case, an adjusting entry is needed to recognize service revenue by this value because you performed part of the service by $400. So service revenue will increase. We now can recognize service revenue. So if we are required to perform adjusting entry on October 31st, can we now recognize service revenue? Of course, because we have performed part of the service by $400. So service revenue, our revenue will increase in the credit side by this value. What about the debit side? Our liability should decrease because now our obligation decreased by $400. So unearned revenue will decrease by the same value. So again, an adjusting entry on October 31st is required to recognize service revenue, to record service revenue by $400 because we performed this part of the service. So our revenue will increase. It will be recorded in the credit side. And at the same time, our obligations, our liability will decrease. So unearned service revenue will decrease by $400, so it will be debt. Okay, let's continue solving the MCQ from your textbook, page 332, which covers objective number 2, adjusting entry for deferrals or prepayments. Question number 7, the trial balance shows supplies $1,350 and supplies expense 0. If $600 of supplies are on hand at the end of the accounting period, the adjusting entry is this is a type of prepaid expense adjusting entry. So this is a type of prepayments adjusting entry. And as we have stated before, the rule says that the adjusting entry, in this case, you should debit or you should increase expense and you should decrease or credit an asset. But first we have to determine the amount of supplies used, which should be recognized as a supplies expense. And we have stated before that supplies expense or supplies used is the difference between supplies, which is $1,350, minus supplies on hand, which is $600, which is $750. What is the correct choice? We have stated before, once you are required to perform an adjusting entry for prepayments, you should increase expense. You should recognize expense by the amount of expenses used. So, supplies expense increased, debited. And at the same time, you should decrease supplies by the same value, which is $750. So, letter C is the correct choice. Question number 8, adjustment for prepaid expenses. Adjustment for prepaid expenses. Decrease asset and increase revenue. I have mentioned this in question number 7, that the adjusting entry for all prepaid expenses is to increase or to debit expense and to decrease or credit an asset. Therefore, based on this rule, letter A is the correct choice. Decrease, you should decrease asset, and at the same time, no, you should decrease assets. Letter C, you should decrease assets and at the same time increase expenses. So adjustment for prepaid expenses, decrease assets and increase expenses. Question number 9. Accumulated depreciation is a contra asset account, is an expense account, is an owner's equity account, or a liability account. Of course, letter E. It's a contra asset account. It's an opposite to asset. It can be, we can deal with accumulated depreciation as an opposite to assets. Question number 10. Rivera Company computes depreciation on delivery equipment at $1,000 for the month of June. The adjusting entry to record this depreciation is as follows. As you see, this is again another type of prepaid expenses, and as we have stated before, the rule says that the adjusting entry for any prepayments, you should debit, you should increase expense, and you should decrease or credit an asset or a contra asset. In our example, in our case, we are talking about depreciation, so we will record on the credit side something called accumulated depreciation. By how much? Here you are required to record adjusting entry for only 1 month, and the depreciation is computed and is given for you for 1 month is $1,000. So so in this case, depreciation expense will be in the debit side and accumulated depreciation. Let's select the correct choice. It will be depreciation expense $1,000, accumulated depreciation for Rivera Company. This is false. Depreciation expense $1,000 and equipment $1,000. We cannot decrease equipment, we cannot decrease assets directly, and we decrease it indirectly through accumulated depreciation. Letter C, depreciation expense 1,000 and accumulated depreciation for equipment. So this is the correct choice. Equipment expense, we don't have something called equipment expense, so the correct choice is letter C. Question number 11. Adjustments for unearned revenue. Adjustment for unearned revenue. If you remember, the rule for adjusting entry for unearned revenue, you should debit or you should decrease a liability, which is unearned revenue. And at the same time, you should recognize, you should increase service revenue by crediting it. Thus, letter A, decrease liability, and increase revenue is the correct choice for this question. Okay, let's now solve some problems from your textbook covering this part of chapter 3, which we have discussed already in prior week and this week. Okay, the ledger of Hammond Company on March 31st, 2017 includes this selected account before the adjusting entries are prepared. We have prepaid insurance, $3,600. We have supplies, $2,800. Equipment, $25,000. Accumulated depreciation, $5,000. And unearned service revenue, $9,200. An analysis of the accounts shows the following. Number 1, insurance expires at the rate of $100 per month. and you are required to prepare adjusting entry for the month of March. So in order to prepare adjusting entry, now we are talking about prepayments, and we have stated before that the adjusting entry for prepayments is to increase or to debit expense, and at the same time you should decrease asset. Based on number 1, when you should recognize expense, when this expense expires, and we are given that at the end of March, insurance expires at a rate of $100 per month. In this case, we can perform the adjusting entry. Insurance expense by $100 because we are recognizing expenses for only 1 month, and at the same time we should decrease asset, which is prepaid insurance expense by the same value. The second time, supplies on hand total $800. Supplies on hand is $800. So we need to determine the amount of supplies used first. Supplies used is equal to supplies available during the period less supplies on hand. The value of supplies on hand is given, $800. What about supplies available during the period? Supplies available during the period, as you see here, it's $2,800. So $2,800. This means that we already used on March 31st $2,000. These $2,000 should be recognized as an expense because it's already used. So the adjusting entry will be supplies expense in the debit side by $2,000. Increased. And at the same time we should decrease supplies by the same value, which is $2,000. Number 3, the equipment depreciates $200 per month. We are required to perform adjusting entry for the equipment. So we have depreciation expense by $200. Can we decrease asset? Can we decrease equipment? No. We will decrease it by an indirect way through something called accumulated depreciation for equipment by $200. And as I have stated before, accumulated depreciation is a contra asset account. It's an opposite of asset account. Requirement number 4. During March, services were performed for 1/2 of the unearned service revenue. So service was performed during March for 1/2 of unearned service revenue. This means that we were having an unearned, we were having liability, obligation, unearned revenue by how much? It's given here, 9,200. And this information provide us, this statement to provide us with additional information. You were having a liability by now 9,200 because you received the cash but you didn't perform the service. Now, on March 31st, services were performed for one half. You performed half of this service. One half is half of this service multiplied by one half, which is equal to 4,600. Can we recognize this 4,600? Yes. Once you perform the service, you can recognize service revenue. So here we have service revenue in the credit side by 4,600 because we already performed this 4,600 and we computed this value from our total liability, total unearned service revenue multiplied by one half, which we already performed. So we increased service revenue. And at the same time, you are required to decrease liability, you are required to decrease unearned revenue by the same value, 4,600. Okay? Okay, let's solve this exercise from your textbook, mainly on from chapter 3 on your textbook, page 339. Brief exercise 3.3. Okay, channel advertising company's trial balance at December 31st shows supplies $6,700 and supplies expenses 0. On December 31st, there are $2,100 of supplies on hand. So you are given supplies available during the period and you are given supplies on hand. And you are required to prepare the adjusting entry at December 31st and using T account, enter the balances in the account and post adjusting entry. So you are required to do two requirements. First, to record an adjusting entry and also to perform or to prepare a T account for these accounts. So again, in order to perform the adjusting entry, this means that you are required now to update your account to recognize supplies, supplies expense. And what is the amount of supplies used? Supplies used is the difference between supplies available during the period, which is $6,700, less supplies on hand, which is $2,100, equal 4,100. And what is the adjusting entry for prepayments expenses in the debit side? You have something called supplies. In this case, this is the adjusting entry. On December 31st, supplies expense will increase by how much? 4,100. At the same time, you should decrease assets. You should decrease supplies by the same value. What about the second requirement, T account? You should prepare the T account for these two accounts. So supplies, supplies. You were having already supplies available during the period $6,700. Then on December 31st, your supplies decreased by this value as a result of the adjusting entry, 4,100. So the balance in the supplies account will be in the debit side. The balance on December 31st will be by the difference, which is 2,100. What about the T account for supplies expense? Based on the adjusting entry, supplies were in the debit side by $4,100, so this will be reported in the T account or transferred in the T account by the same value. So December 31st balance is $4,100. Okay, the second brief exercise 3.4, which is also in the textbook, page 339. At the end of its first year, the trial balance of Wallwood's company shows equipment $30,000 and zero balances in the accumulated depreciation for the equipment. And depreciation expense for the year is estimated to be $3,750. So the annual depreciation for this equipment is $3,750. Prepare the annual adjusting entry for depreciation at December 31st. Then post the adjustment to T account and indicate the balance sheet presentation of the equipment at December 31st. So here we have, or we are required to perform three requirements. First, you are required to perform adjusting entry, and as we have stated before, adjusting entry on December 31st for on depreciating the equipment, you should recognize depreciation. You should recognize expense. Here, this is depreciation expense. Depreciation expense this is an annual depreciation. Yes, you are required to prepare an annual depreciation, and the annual depreciation is $3,750. What about the credit side? Can we decrease equipment? No, the original cost of the equipment we should keep this cost in the balance sheet presentation with the same value. So we have another option. We will decrease this indirectly through accumulated depreciation. Depreciation for equipment by how much? By the same value, $3,750. Okay, then you are required to prepare a T account. T account for depreciation expense. Transfer this value on the debit side. So on December 31st, the balance is $3,750. What about accumulated depreciation? Transfers this value. December 31st, balance is $3,750. What about balance sheet presentation? balance sheet at December 31st, you are required to list assets, and we have here equipment, and we will report the equipment by the same value, by the original cost of this equipment, which is $30,000. And also we are required to report in the balance sheet accumulated depreciation, but we have stated before that accumulated depreciation is a contra asset account. Since it is a contra asset account, it will be deducted from assets. Accumulated depreciation for equipment by $3,750. This item will be deducted. This will give us or provide us with $26,250, and we can call this as the book value or the carrying value of the equipment. Okay, let's solve a brief exercise 3.5, which is also on page 339 in the text. On July 1st, 2019, major corporation pays $15,120 to Mesa Insurance Company for a 4-year insurance contract. This means that major company paid in advance insurance which will be used or will expire after 4 years. Both companies have a physical year ending on December 31st. If you are now, we are talking about major corporation, and you are required to journalize and post the entry on July 1st and the annual adjusting entry on December 31st. If I'm talking about major corporation or major company, this means that major pays $15,120. So our cash decreased because we purchased insurance. On July 1st, what happened? You are required to journalize entry on July 1st. Did you receive the cash or you paid cash? If I'm talking about major company, I paid cash. I purchased insurance. So when you pay cash, your cash decrease by this value, which is $15,120. What happened or what should be reported on the debit side? Did you use this insurance? This insurance expired? No, so we cannot recognize now expenses. What happened? We paid this in advance for a 4-year insurance. So we have an asset, and the asset is called paid insurance expense. By how much? By the same value. What about the adjusting entry, the second requirement, on December 31st? On December? What happened on December 31st? On December 31st, we are required, you purchased this on July 1st. So from July 1st to December 31st, on December 31st, what happened? The insurance expired. And how many months of insurance expired on December 31st? We have July, August, September, November, October, December. So on December 31st, 6 months of insurance is expired. So now we can recognize, we can record these 6 months as an insurance expense. So the adjusting entry will be insurance expense in the debit side. And at the same time, you should decrease prepaid insurance expense. But by how much? This is for 6 months only. Can we calculate this value? Yes. We have the total value of insurance is 15,120. Let's first calculate the annual insurance. We can divide it, so annual insurance, we can divide it. We purchase this insurance for 4 years. So each year, a value of 3,780 expire. And on December 31st, is it a complete year expired? No, 6 months only expired. So how we will calculate the value of the 6 months? Annual insurance, 3,780, I'm sorry. Multiplied by 6 over 12, which is equal 1,890 for 6 months of insurance which is expired. 1,890 will be the value here. 1,890, 1,890. So again, the adjusting entry on December 31st for 6 months of insurance is to increase insurance expense by 1,890, and at the same time we decreased our asset prepaid insurance by the same value because this amount is already expired and we used this amount of insurance. Okay, here we come to the end of our lecture. We completed, or we discussed in this lecture completed discussing objective number 1, and also we finalized objective number 3 in relation to chapter 3, and in our face-to-face lecture we will continue discussing chapter 3. Stay safe and thank you.